students, myself Saurabh Shirke. I welcome you to Loka and IAS Academy. All of you know that we have started Economy Insight series. Until now we have discussed 5 topics. Okay, which are those topics? You can see Loka and IAS Economy Insight series playlist. Okay, if you haven't watched them, I request you to please watch them. Now in this video, we are going to discuss UPSC PYQs from finance and investment topic. So what we are going to do, we will discuss MCQ, then we will also discuss incorrect options. Okay, MCQ and correct answer here, sorry. And then incorrect options and important themes from prelim 2024. So all these things we are going to discuss. So you will get comprehensive knowledge regarding all the PYQs. So let's start the video. So first question is, in which of the following is issued by registered foreign portfolio investors? So underline this. Okay, issued by registered foreign portfolio investors to overseas investors who want to be part of Indian stock market without registering themselves directly. Okay, so go through each and every option. See, first one is certificate of deposit. All of you know that what is meant by certificate of deposit. So certificate of deposit nothing but it's like a fixed deposit. Okay, we invest something money and we get return after 2-3 years. But what is the difference between fixed deposit and certificate deposit? Fixed deposit is not tradable, but certificate of deposit, yes, it is tradable, and it is issued by banks. Okay, so certificate of deposit is clearly not issued by foreign portfolio investors. This is incorrect option. Then comes commercial paper. Commercial paper is unsecured loan. It is an unsecured loan issued by corporates. Why is it unsecured loan? Because it is not backed by collateral. Not backed by collateral. That's why we call it unsecured loan. So it is also issued by corporate but not by registered portfolio investors. So this is also incorrect. Then promissory note. All of you know what is meant promissory note. Okay, if there are two individuals, say A and B, and A is obligated to pay certain amount to B. So A will sign a promissory note and write it here that A is obliged to pay some certain amount on by this date, etc. This document is known as promissory note. So it is also not a document which is issued by a registered portfolio investor. So we are left with only one option, that is participatory note. So answer is D, participatory note. But let's understand about participatory note also. Okay, participatory note is also known as offshore derivative instrument. Okay, P note, or it is also known as offshore derivative instrument. Okay, what happens? Generally consider investors as A, B, C, D. If they want to invest in Indian stock market, they cannot easily invest in it. Okay, there are a lot of paperwork, registration, etc. And all of you know that in India, we do not have 100% capital account convertibility. We have certain current account convertibility. So what is the easier way to invest in Indian market? So what these investors will do? These investors will invest in Indian stock market through a foreign portfolio investors. They will channel their fund in Indian stock market through this FPI. This FPI will invest their funds in Indian stock market. And for this purpose, this FPI will issue P notes to these investors. Okay, and these P notes derive their substantial value from shares of Indian stock market. This is the simple mechanism of P notes. So understand it carefully. Okay, here you can pause the video and read this content. You can also take a screenshot. See here, what is certificate of deposit? Certificate of deposit issued by All India Financial Institution or Scheduled Commercial Bank, and they are issued at discount. Okay, what is meant by issuing a discount, that we'll see in one of the next questions. So this is certificate of deposit. Then commercial paper. Commercial papers, okay, commercial paper was introduced in 1990 to allow high rated corporate borrowers to diversify their sources. You can issue commercial paper, corporates, primary dealers and financial institutions. So, and this is a example of promissory note. Here you can see it is stamp I dash dash do promise to pay sum of this to this much to this person, etc. So this is the promissory note, and these are P notes or offshore derivative instruments. Okay, what is the key characteristic of P notes? Okay, investors are not registered with SEBI. Okay, due to this fact, many economists has raised concern regarding the source of the fund. Is the terror fund coming to India through P notes, etc. So SEBI has increased the scrutiny of P notes. So our answer is D, P notes. So this question was asked in 2019. Now see what question UPSC asked in 2020. See here, commercial paper, certificate deposit. Okay, these two options we already discussed in 2019. So that is the benefit of solving PYQs. Now see here, commercial paper is a short term unsecured promissory note. Okay, certificate deposit is a long term instrument issued by Reserve Bank of India to corporation. This is incorrect. Okay, Reserve Bank of India doesn't issue certificate of deposit. So eliminate 2. So you are left with 4 only or 1 and 3 only. And we know that first one is correct statement. So only option remains is C, that is 1 and 3. Okay, call money is a short term finance used for interbank transaction. This is correct. Now see, zero coupon bonds are the interest bearing bond. See the contradiction, zero coupon bond, and here is interest bearing bond. Interest bearing short term bond issued by Scheduled Commercial Bank. This is incorrect, because see, zero coupon bond doesn't have interest rate. They are issued at discounted price. Let's see that. Okay, zero coupon bond, a debt security that doesn't pay interest but instead trades at a deep discount. For example, here is a zero coupon bond. Okay, its face value say rupees 100, but it will be sold to investor at a discounted price, let's say rupees 90, and at the maturity investor will redeem at face value, that is rupees 100. So this is the concept of zero coupon bond issued at discounted price, okay, not at face value. And here are some interbank lending. So call money is for a single day, short money for 1 to 14 days, and notice money for 14 to 364 days. So answer is 1 and 3. Understand the concept of zero coupon bonds. Okay, now next question. In the context of Indian economy, non-financial debt includes which of the following? Now understand there are two major types of debt. The debt are classified in two types: financial debt and non-financial debt. Financial debt is that debt, that borrowing which is borrowed by financial sector, for example banks, and all other borrowings apart from financial sector are non-financial debt. So see here, housing loans, so obviously it is non-financial entity. Amount outstanding on credit card, this is also non-financial entity. treasury bills are issued by government, so obviously it is a non-financial entity, no banks, NBFC, etc. involved. So all 1, 2, 3 are examples of non-financial debt. Okay, here you can see here two types: financial debt and non-financial debt. Financial debt is borrowings by financial sector, that is banks, and non-financial debt government debt, private non-financial debt, household debt, etc. Okay, so I hope these concepts are clear. Let's move to next question. Okay, now this question is regarding retail direct scheme of RBI, which was introduced in year 2021. Okay, so first statement: retail investors through demat account can invest in treasury bills and Government of India debt bonds in primary market. Okay, the negotiated dealing system order matching is a government security trading platform of the RBI. Central Depository Services Limited is jointly promoted by Reserve Bank of India and Bombay Stock Exchange. Now you must be aware with current happening to solve this question. Okay, so here before discussing the answer, let's discuss the earlier mechanism of buying government securities. So earlier what used to happen? See, government securities are not issued or sold or by directly by government. Okay, they are sold by RBI on behalf of government. So what happened? RBI sells government securities in primary market. Okay, then retail investors cannot directly purchase these securities here. Okay, and remember how RBI sells it through eKuber platform. Okay, and here the participants purchases it, not retail participants. Okay, eKuber participants. Now retail investors can purchase these securities on secondary market. Okay, for that they must have a demat account. Okay, or they can indirectly purchase by paying a commission to eKuber participants. And on secondary, how can they purchase in secondary market? Through stock exchange or NDS OM. See here mentioned negotiated dealing system order matching. So what is NDS OM? That we will also see in one of the next questions. It is a system of government. This is system of government securities trading platform of RBI. So this is correct statement. So you can see here. Now what happened after introduction of retail direct scheme? After the introduction of scheme, these government securities are sold on retail direct platform. A platform is created. Retail direct platform, and retail investors can purchase government securities in primary market itself. Retail investors can purchase securities in primary market itself on the platform. Okay, so there are also some conditions. They have to maintain a certain account on that platform, but no need to go in such detail. What you have to understand that earlier, before the introduction of scheme, retail investors cannot purchase government securities in the primary market. Okay, they have to purchase it through eKuber participant by paying them certain commission, or in secondary market to stock exchange or NDS OM. So see here, retail investors through demat account can invest in treasury bills and Government of India bonds in primary market. So this is also correct. Now see third statement, Central Depository Services Limited is jointly promoted by RBI and BSE. No, it is incorrect. It is promoted by BSE, not RBI. So correct answer is B, that is 1 and 2. Okay, here you can see the newspaper advertisement of retail direct scheme. Okay, invest directly in government securities. So obviously, so always pay careful attention to such advertisements of RBI in newspaper. Okay, where you can invest treasury bills, sovereign gold bond, floating rate savings bond. Okay, zero brokerage and no other fees. Easy and convenient mode of payment. So very important. Okay, so what is NDSOM? You can pause your video and read from here. Okay, so what is NDSOM? Screen based electronic anonymous order matching system for secondary market trading in government securities owned by RBI. Okay, presently membership of the system is open to entities like banks, primary dealers, insurance company, mutual fund, etc. who maintain SGL accounts with RBI. So this is the NDSOM. Okay, I hope the question is clear. Let's move to next question. Okay, the Reserve Bank of India. This question is pertaining to role of Reserve Bank of India as a debt manager. Reserve Bank of India manages and services Government of India securities, but not any state government securities. This is incorrect. Okay, Reserve Bank of India does the same thing for state governments also. Treasury bills are issued by Government of India, and there are no treasury bills issued by state governments. Okay, this is correct statement. Treasury bills are issued by only central government, and state governments issue state development loans. Treasury bills are issued at a discount from par value. This is also correct. So what is meant by issuing at a discount? We have already discussed. Okay, so answer is 2 and 3. Okay, as I have said to you at the starting of video that we will not restrict only to the question discussion, but we will also discuss some important themes from upcoming prelim perspective. So let's discuss ways and means of advances. Okay, see, after 1991 reforms, and 2003 FRBM Act, there was a check on government spending. Government cannot arbitrarily issue bonds to RBI and seek loan. Okay, so this is not possible. Government can raise borrowings by issuing bonds from markets to banks and other entities. It cannot directly borrow from RBI. Okay, except there are some circumstances where it can borrow from RBI. Those circumstances are mentioned in FRBM Act. Okay, like collapse of agriculture, reduction in tax revenue, etc. Okay, just check what are the circumstances. There are various circumstances. So they come up with ways and means of advances. Why? To bridge the temporary mismatch between receipts and expenditure. Okay, so remember, temporary mismatch. Government cannot finance budget deficit through this. the lending will be at repo rate, okay, for certain period. If that certain period is extended, then there will be penal rate. This is ways and means of advances. Okay, so government has to borrow from RBI through this way only. Okay, long term borrowing is only allowed under certain circumstances. Please check which are those circumstances. They are mentioned in FRBM Act. Okay, so the answer is, as we have discussed, 2 and 3. C. Okay, now question on foreign direct investment. Now we will see at least 3 to 4 questions on foreign direct investment. Okay, what we will do, we will discuss each and question, and along with the answers, we will also discuss important prelim pointers from 2024 perspective. Now question is, with respect to foreign direct investment in India, which one of the following is considered as major characteristic? Let's see the answer. It is the investment through capital instruments essentially in a listed company. It is largely a non-debt creating capital flow. It is the investment which involves debt servicing. So this is obviously incorrect. You can straight away eliminate it. It is the investment made by foreign institutional investors in government security. This is not FDI but FII. We can say FPI. So you are left with 2 options. So read first option. It is the investment through capital instrument essentially in a listed company. So for that you must be aware with the changed definition of FDI. So as per Arvind Mayaram committee, what is the definition of FDI? %10% or more investment in listed company, or any investment in unlisted company. Because this is the definition of FDI. So first statement is incorrect, but it is mentioned that essentially in listed company. Now second, it is a largely non-debt creating capital flow. Yeah, this is correct. So B is correct because FDI is mainly invested in physical assets, etc. Okay, so B is the correct option. Now let's see the important prelim pointers. See here, Arvind Mayaram committee, FDI 10% or more investment in a listed company and any investment in a unlisted Indian company. Now there are 2 routes, okay, government route and automatic route. In government route you have to take approval of concerned ministry. Remember this. Okay, UPSC may give you option that that approval of parliament is necessary. So remember this is incorrect. And in automatic route, no prior approval is required. So as FDI, state, as far as state concerned, it is Maharashtra, and sector concerned is services. This is easy. Okay, you can understand this with the general sense. Okay, so FDI will be obviously in services sector more. And also remember, if FDI is coming from neighboring country which shares direct border with India, then government approval is mandatory. So remember it. Okay, now important question, which of the following are treated as artificial currency? Because answer, straightway answer is C, that is SDR. Now what is SDR? That we have discussed in first or second video, so please refer it. But what is important here, understand what is ADR, GDR. Okay, ADR is American Depository Receipt and GDR is Global Depository Receipt. Similarly, there is also concept of IDR, okay, Indian Depository Receipts. Okay, so let's see it. Okay, for that, understand that American company cannot directly invest in Indian stock market. Cannot directly invest in Indian stock market. In similar way, Indian company cannot invest directly in American stock market. So what to do? So here ADR and GDR becomes useful. Now let's see how Indian company can issue shares in American stock market. Suppose there is company Infosys. So what Infosys will do? Infosys will go to American depository. Okay, and Infosys will deposit shares. And for this share, this depository will issue ADRs, American Depository Receipts. And these ADRs will have their underlying value from shares of Infosys. And these ADRs will be traded in US stock exchange. Okay, ADR will be in US stock exchange. It will be traded in US stock exchange, and investor will earn their dividends in dollars. So this is the mechanism of American depository receipts. Now same is the case with global depository receipts. What is the difference between ADR and GDR is that American depository receipts, that is ADRs, are issued in US stock market, and GDR generally issued in European stock market. Okay, so this is the concept regarding ADR and GDR. Now remember, same is the mechanism with IDR, Indian Depository Receipts. Okay, American company will come to Indian depository, okay, deposit their shares, get IDRs. Indian investors will invest in it and earn profit in rupee. Okay, so this is regarding ADR, GDR and IDR. Let's read it. See here, you can read this. Depository receipt is an instrument issued by domestic companies to raise money outside the country. Examples are ADR and GDR. This we already discussed. ADR. See, GDR are receipts like ADR, but they are okay. GDR are like ADR except for the fact that it is listed on exchange outside United States and help the issuer to raise funds simultaneously in different markets like Luxembourg or London. Okay. See, you can pause the video and read it because we have already discussed it. Okay, now read here. Important from your 2024 prelim. RBI to allow investment trading of sovereign green bonds at IFSC, Gujarat. Now, the American investors need not to buy IDRs. They have to register themselves on IFSC and they can directly purchase the sovereign green bonds. So like we solved the question on retail direct scheme. So remember this also. Okay, how they frame question on retail direct scheme, they can frame a question on sovereign green bond. Okay, another important news is to tap global capital, Indian firm can list directly on IFSC exchanges. Okay, Indian firms need not to go US, purchase the depositories. Okay, not purchase, can Indian investors need not to go to US, deposit their shares, get American depositories to raise fund. They can directly list themselves on IFSC exchange and raise fund. So remember this. And important prelim pointers regarding ADRs and GDRs. See here, first point is very important. Only listed Indian company issue ADRs and GDRs. It is only listed Indian company can raise funds from outside the India, not unlisted company. Countries where depositories are issued must be members of FATF, Financial Action Task Force. This is also important point. Okay, now read the third point that is written in reading. That is, Indian residents cannot buy ADR and GDR. Very important point. And last and important point, considered as FDI. ADR and GDRs are considered as FDI. Okay. So I told you this, all these things. Let's see it. Next question. Now next question, which of the above can be included in foreign direct investment? Now you can see how UPSC is evolving. Earlier UPSC asked feature of FDI. Now UPSC asked give 4 options and they asked which of these instruments are FDI. Okay, so read the third one, global depository receipts. You already discussed that global depository receipts are considered as FDI. So third one is correct. So you are only left with 3 only and 1, 2, 3. Now you can eliminate fourth one. External deposits are not FDI. Foreign currency convertible bonds, yes, obviously they are FDI. Foreign institutional investment with certain conditions. Which is this certain condition? You already see 10% or more in listed company. What is the second condition? Any investment in unlisted company. Any investment in unlisted company. So these are the 2 conditions. So our answer is A, that is 1, 2 and 3. Okay, read this. FDI from border sharing country compulsorily under government rule. So that is, for example, if there is a FDI from say Pakistan or China, it must come through government route, that it must take permission from concerned ministry. Okay. Now also see who can receive FDI: companies, partnership firms, venture capital fund, LLPs, there is limited liability partnership. We will see one MCQ on LLPs and startups. And which are the instruments? Shares, debentures, foreign currency convertible bonds and depository receipts, that is ADRs and GDRs. So please focus here. This is important from your prelim perspective. Okay, now again a very important question on bond yields. Okay, so pay attention carefully. This is very important because in successive years UPSC asked question on bond yield. So we will discuss this question and also discuss another parameters, another dimensions on which you may face question. Okay, so question is, Indian government bond yields are influenced by which of the following? Actions of United States Federal Reserve, actions of Reserve Bank of India, inflation and short-term interest rates. Now before solving this question, let's understand what is a bond yield. So bond yield is nothing but percentage return on bond. Okay, suppose there is a bond with face value 100 rupees. and after maturity you are receiving 110 rupees, then you can say your yield is 10%, okay, or rupees 10. The average return that you are getting is known as bond yield. Now what is important is to know the relationship between bond yield and bond price. Are they directly proportional or are they inversely proportional? Let's see it. Okay, suppose consider a bond with face value rupees 100. Then the interest rate is say 10% with maturity 1 year. Okay, so after 1 year investor will receive 110 rupees. Okay, now consider two scenarios. Okay, suppose the investor sells the bond in secondary market. This investor A now sells the bond in secondary market. Suppose he sells the bond to B at say rupees 90. So investor A will sell the bond to investor B to rupees 90. Now after 1 year investor B will receive rupees 110. So obviously the percentage return that investor B is getting is more than 10%. So yield has increased. Yield has increased. Now see the second scenario. Suppose investor A sells the bond to investor C for rupees 110. Okay. Now see, the investor C will after 1 year receive same amount, rupees 110. Okay, let's change it, not 110 but 105. So here he is getting only 5 rupees as an extra, which is obviously less than 10%, that is bond yield. So here yield has reduced. So what you must remember here is bond yield is inversely proportional to bond price. I have explained you how it is. Okay, so coming back to question, remember this. See, all these actions impact the bond yield, that is actions of United States, actions of RBI, and inflation. This is obvious option, as you can understand easily. So 1, 2, 3 is the correct option. But how it impact the bond yields, we have to understand that, because based on that understanding we can solve the upcoming questions in UPSC examination. Okay, actions of US Fed Reserve. See, you might have read the word taper tantrum in newspaper often. So it is regarding US Fed Bank policies. A taper tantrum has two components: quantitative easing and Fed tapering. Quantitative easing, nothing but expansionary policy of US Fed. Expansionary policy of Fed. Fed means Federal Reserve. Okay, Central Bank of United States. So what happens in expansionary policy? Interest rates are reduced so that more credit will be available. So when US Central Bank reduces the interest rate, so investor pull out their money from US and they look for some emerging markets like India and China to invest their money. So what quantitative easing leads to? Investment in India. So what does it lead to? More demand for government securities. Because government securities is almost a risk-free instrument. So more is the demand, more is the price. We have seen here, bond price is inversely proportional to bond yield. So ultimately, bond yield is reduced. Okay. So quantitative easing leads to reduction in bond yield. Now let's see Fed tapering. Fed tapering means calibrated tightening. So what happens? Interest rate increases. So when interest rate increases, investors pull out their money from emerging market and invest in United States. Okay, so there is capital flight from India. Okay, so investment in India reduces. So low demand for government securities. Lower the demand, lower the price. Okay, so yield is more since they are inversely proportional. Bond yield increases. So this is the relation you must know. Because see, in 2022, UPSC just checked your understanding regarding whether you know that United actions of US Fed Reserve affects the bond yield or not. In upcoming years, UPSC may check how the actions of US Fed affect the bond yield, how quantitative easing affects the bond yield, whether it increases the bond yield or reduces it. So that is important. So that you have understood here. Okay, now what is the relationship between government borrowing and bond yield? Let's see it. Okay, suppose there is slowdown in the economy. Okay, slowdown, or we can say we can take another scenario. We can also take obviously slowdown, but let's take another scenario. Suppose there is need of government expenditure, like after post-pandemic, during post-pandemic period, private investors were not ready to invest, so government took the initiative of expenditure. So government incurred expenditure. So what government did? Government borrowed money. So more government securities in market. Okay, so more government securities means low price. The law of demand and supply. Lower the price, bond yield increases. In similar way, when there is low government borrowing, okay, less number of government securities. The government securities are less in number, they have high value, high price. Higher the price, lower the yield. Okay, So what you can conclude here, when there is more borrowing, yield increases. Lower borrowing reduces the yield. Lower borrowing reduces yield, and more borrowing increases the yield. So direct relationship. Now, how actions of RBI influence the bond yield? Okay, see here RBI takes various actions. Okay, increase in repo rate, decrease in repo rate, and another major action that is taken by RBI is open market operation. OMOs, open market operation. So if RBI excessively undertook the open market operations, and RBI sold excessive government securities, then there will be more government securities in the market. So more the government securities, less is their price, and as the price will be low, so bond yield will be high, because they are inversely proportional. Okay, so in this way RBI actions can also affect the bond yield. Okay, for your homework you can think upon operation twist, which we have discussed in the topic of monetary policy, and you can think of its effect on bond yield. This is for your homework. So this is the detailed explanation of this question, how the bond yields are affected by inflation. Obviously inflation will also affect bond yield, because in inflation RBI will carry out calibrated tightening, and this will have effect on bond yield. So 1, 2, 3 is the correct answer. Okay, now another important question regarding inflation indexed bonds. Okay, so statements are: government can reduce the coupon rates on its borrowing by way of IIBs. IIBs provide protection to the investors from uncertainty regarding inflation, and the interest received as well as capital gains on IIBs are not taxable. Okay, this is little bit tricky statement. So you might have seen such statements in various years UPSC questions. So generally they are wrong, because why will not that be taxable? Already government is giving you the benefit of inflation indexing. What is meant by that we will see. But inflation index, by reading it you can understand that certain benefit is given. So already you are receiving benefit, why will you receive another benefit in form of tax exemption? So this is incorrect. So you can directly come to answer 1 and 2. But we have to also understand what is the concept of inflation indexed bonds. So let us understand it. Okay, before understanding inflation indexed bonds, let us understand normal bonds. Suppose this is a normal bond, okay, whose face value say rupees 100, interest rate 5%, and maturity 1 year. So after 1 year you will receive 105 rupees. But what if the inflation during that 1 year is 6%? Okay, so in actual sense you haven't gained anything. Okay, because the purchasing value of rupees 105 is less in current year. So the solution is inflation index bond. So what we do, we index the price of bond to the inflation. So let's consider various scenarios. Okay, same bond with face value rupees 100, maturity 1 year, and interest rate 5%. Now what happens in normal bond? In normal bond you will receive 5% of rupees 100 as an additional, okay, plus 100. But in case of inflation index bond, suppose the inflation during the preceding year was 6%. So principal will become, your principal will not be 100, but your principal will be 106. So you will have interest of 5% of 106. So this is the benefit of inflation index bonds. Now consider second scenario. Face value all same. If here inflation is negative 2%, so you may think that here investor is in loss. But remember the characteristic of inflation index bond. The investor will receive in face value or inflation adjusted value. Investor will receive one of the value which is higher, So for example, in this case when inflation is 6%, the investor will receive 6% of this additional principal. This is 106. But here inflation is negative 2%. So here you might think that investor will receive 2% of 98 rupees. But that is not the case. But what is the higher here? 100 rupees face value. The investor will receive 2% of face value. See, this is the difference. Now focus here. Government can reduce the coupon rates on its borrowing by IIBs. So here government cannot reduce the coupon rate after issuing. What is the general meaning of this statement? That government can overall reduce the coupon rate. For example, in current year, suppose there is government bond with interest rate of 10%. But for inflation index bond, government can say, I am offering you 6% interest rate because already I am giving you benefit of inflation indexation. Okay, so in this way government can reduce the coupon rates. Okay, don't think that government has issued bond, okay, and if there is a deflation then government will reduce the coupon rate. No, that is not the case. Okay, so answer is 1 and 2. Okay, another question. With reference to foreign owned e-commerce firms operating in India, which of the following statements are correct? Okay, now remember there are two models. First one is inventory model, second one is market model. What is the inventory model? That model which is prevalent in US in case of Walmart. So they store all the things and then they sell. But in market model, you suppose you order a book on Amazon, then they will purchase it from market and then they will sell it to you. Okay, so read the first statement. They can sell their own goods in addition to offering their platform as a marketplaces. This is incorrect. And second, the degree to which they can own a big sellers on their platform is limited. This is correct. What is the cap? 25%. and no FDI in inventory based model. Okay, FDI is allowed only in market based model. So answer is B, that is 2 only. Now next question, with reference to Indian economy, consider the following statements. A share of the household financial saving goes towards government borrowing. So this is obviously correct statement. Okay, household financial savings has various instruments. One of them is post office savings. Okay, or other some instrument like Sukanya Samruddhi Yojana. All these savings are deposited in public account of India. Public account of India. So that it goes towards government borrowing. So this is correct. Then second, dated securities issued at market related rates in auctions form a large component of internal debt. This is also correct. So answer is C, that is 1 and 2 only. Now let's see the graph from interim budget. So have a look over left side, that is first chart table. You can see here market borrowings, short term borrowings, securities against small saving. Third one here, small saving, this is households small savings, household saving. So these securities against small savings are part of household saving. Okay, and then state provident fund, etc. So this goes towards government borrowings. First statement is correct. Now see here, the green line, market borrowing through government securities. The yellow one, short term T-bills and other instruments. Or other way you can see here also, short term borrowing 5,000 crore. So this is also component of government debt, important component. Both these statements are correct. So carefully look at both these tables and do not memorize the absolute figures, but focus on trends. Okay, whether the market borrowing is consistently increasing over last 5 years or it has some fluctuations, which is the highest component. So whether it is securities against small saving, short term borrowings, okay, or market borrowing. So focus here. Okay, here focus what is more, external debt or internal debt. So observe the trend. Okay, with reference to convertible bonds, consider the following statement. Easy question. As there is an option to exchange the bond for equity, convertible bonds pay a lower rate of interest. This is correct because already we are extending benefit of bond conversion. Okay, bond conversion for equity. The option to convert to equity afford the bondholder degree of indexation to rising consumer prices. This is also correct. So answer is C, that is 1 and 2. Simple question. Okay, now next question is regarding infrastructure investment trust. Okay, so before solving the question, let's briefly discuss what do you mean by infrastructure investment trust. Okay, so before understanding infrastructure investment trust, let's understand it through example of mutual funds. What mutual funds do? They pool investment from various investors. And invest in shares. Same is the case with infrastructure investment trust. InvITs, where they pool investments from various sources and then invest in infrastructure. Okay, in India they mainly invest in road infrastructure or power transmission line. The roads they can collect tolls, okay, and distribute the profit to investors. This is infrastructure investment trust. And also there is another called as real estate investment trust. Okay, in this case also the mechanism is same, but instead of infrastructure it invests in real estate projects. So please go through REITs also. So this is regarding REIT. Now let's see the question. Okay, interest income from the deposits of infrastructure investment trust distributed to the investors is exempted from tax, but the dividend is taxable. No, this is incorrect. Okay, because interest income is also taxable. And second, InvITs are recognized as borrowers under Securitization and Reconstruction of Financial Assets and Enforcement Security Interest Act 2002. This is the current news, and this is also correct. So statement 1 is incorrect and 2 is correct. Next question is regarding money market and capital market. So before solving this question, let's understand the difference between money market and capital market. So we have financial market, okay, and there is two broad classifications: money market and capital market. Okay, so based upon the time duration, so the instruments used in money market are generally of less than 1 year. Okay, in a year more than 1 year. Okay, so in short we can say money market is short term, capital market long term. How can you remember this? Consider money as notes, coin. So relate it with short term. And capital means an asset on the long term asset. So in this way remember it. Okay, and since the period is less, so risk is low. And here high risk. Since risk is low, returns are also low. Here high returns. Okay, money market is regulated by RBI, capital market regulated by SEBI. So that is the basic difference. Now see here the options. How many of the above are included in capital market? Means out long term. Solving with just few questions ago we discussed this call money market is for short term duration. Okay, so this is money market treasury bill market, all we know 91, 182 and 364 days. It is also money market. But stock market, no, it is a capital market. And government bond market, it is also capital market. So option 2 and 3 are part of money market, and 1 and 4 are part of capital market. Sorry, we have to identify capital market. So 1 and 4, so only 2 options is the correct answer. Okay, so read the question carefully. In upcoming examination, you may be asked to identify money market. So understand the concept and then you can solve any question. Okay, now very easy question. How many of the above are considered as intangible investments? Focus on what? Intangible. So previously also UPSC had asked about human capital, and there also this option was there, intangible assets. Because intangible that you cannot measure, Okay, you cannot physically experience. Because brand recognition, yes, it is intangible. Inventory, it is tangible. Okay, intellectual property, yes, it is intangible. Mailing list of client, it is intangible. So only first and third options are intangible investments. So option is again only 2 is the correct answer. Okay, now this is a relatively tricky question. Okay, same concept FDI FI but tricky question. Already in previous questions we have discussed what constitutes FDI and what constitutes FII. So let's solve this question. Both FDI and FII are related to investments in a country. Which one of the following statement best represents an important difference between the two? So we have to identify the difference, best difference. Okay, best option which shows difference between these two. FII helps bring better management skills and technology, while FDI only brings capital. It is exactly opposite. Okay, FDI brings management, okay, and technology, and FII only capital. FII helps in increasing capital availability in general, while FDI only targets specific sector. This statement seems correct, but do not mark it immediately. Okay, read remaining statements also. FDI flows only into secondary market, while FII targets primary markets. So this is clearly incorrect statement. No such condition is there. FII is considered to be more stable than FDI. No, this is also incorrect. Okay, FII is volatile. So we are only left with statement B, and that is the correct statement. FII helps in increasing capital availability. Yes, correct. And generally, see, in general, okay, while FDI only targets specific sector. You know, we have various sectors. For example, in space, we have allowed 100% FDI. In payment banks, which we will see tomorrow, in payment banks we have 74% FDI. Okay, in some sector we have 26% FDI. In some sector FDI is not allowed. Okay, so many conditions are there. So that's why FDI targets specific sectors. So here option B is the correct option. Okay, now question regarding disinvestment. Why is the government of India disinvesting its equity from central public sector enterprises? Okay, the government intends to use the revenue earned from disinvestment mainly to pay back external debt. Okay, this is incorrect statement because it is illogical, and already I had shown you yesterday. See the external debt of India. Okay, very low as compared to internal debt. Then why would government disinvest for paying back external debt? Okay, so illogical statement. So first one is incorrect, and government no longer intends to retain the management control of CPSE. This is again incorrect statement. Okay, because government has identified certain priority areas where it intends to have the management control of public sector undertakings. So this is the correct answer. Why is government undertaking investment? Because government wants to increase the ownership of public. Disinvestment to increase ownership of public. You can read this on website of DIPAM. To increase the ownership of public. Okay, this is the main motive. So let's understand the difference between disinvestment and strategic disinvestment. Okay, disinvestment can happen when government reduces its stake. This is simple. When privatization happens when government is left with minority stake, means less than 50%. This is the condition of disinvestment and privatization. Now let's see what is strategic disinvestment. Strategic disinvestment happens when government has minority share or government has majority share but no management control. No management control. So this is strategic disinvestment. Okay, in privatization, government share is less than 50%. Okay, this can be also strategic disinvestment. But there is another case of strategic disinvestment, that is government may be having more than 50% of share, but government has given management control to private players. So this is also strategic disinvestment. Let's see it. Okay, strategic disinvestment or privatization and minority stake sale in CPSEs. Strategic disinvestment implies substantial sale of government shareholding along with transfer of management control. So this is the key condition. Okay, in case of privatization, which is a subset of strategic disinvestment. Okay, remember, privatization is a subset of strategic disinvestment. The government equity in CPSE and its management control is transferred to private player. Okay, similarly you can read about minority stake sale. Okay, so let's see next question. Again, an easy question. Which of the following include foreign direct investment in India? Okay, FDI, and here is portfolio investment. So remove it. Okay, now you are left with 1, 3 and 1, 2, 3. Okay, so 1 and 3 is correct. Majority foreign equity holding in Indian company. Okay, so this is also correct option. So answer is D, that is 1, 2, 3. Okay, now important recent news regarding FDI. Okay, 100% FDI to be allowed in space sector. See the recent announcement. Okay, the liberalized entry routes under the amended policy are aimed to attract potential investors to invest in Indian companies in space. Okay, this is the current news. So remember, Indian government has allowed 100% FDI in space sector. Okay, then this is the general trend. Who are the largest sources? Netherlands, Singapore, Japan, USA, Mauritius account for 70% of FDI. Okay, now next question. What does venture capital mean? Okay, if you have basic knowledge of English language, then you can solve this question easily. Focus on this word, venture. So what do you think? What can be answer? Because short-term capital fund, in short term there is low risk. So incorrect. Funds provided to industries at a time of incurring losses. This seems to be correct, but it is incorrect. Funds provided for replacement as innovation industries. Incorrect. Long-term startup capital provided to new entrepreneur. Long-term new entrepreneur. So here is also risk. And since the entrepreneur is new, so here is also risk. So this is the correct description of venture capital. Okay, now important question. Okay, so we will discuss this holistically, this question, not only just answer but also other dimensions of question. See here, with reference to IFC Masala bond. So before solving the question, let's discuss about Masala bond and Maharaja bonds. So both are issued by International Finance Corporation, an arm of World Bank. Now both are rupee denominated bonds. Okay, both are rupee denominated bonds issued by IFC. Only difference is where are they issued. So, Masala bonds are offshore instruments, means they are issued outside India. and Maharaja bonds are onshore instruments. Okay, now let's see the question. The International Finance Corporation, which offers these bonds, is an arm of World Bank. This is correct statement. Then second one, they are the rupee denominated bonds and are a source of debt financing for public and private sector. This is also correct statement. So both 1 and 2 are correct statement. Now see, this question was asked in 2016. Okay, so while approaching for prelim exam, you will solve previous year question. So in 2016 you will solve this question, but you shouldn't stop at only answer of the question. You should understand the mechanism of masala bonds. Okay, and why it would be better for domestic entrepreneurs, because it reduces the exchange rate risk. How it reduces exchange rate risk, that we will discuss. But before discussing it, let's see how UPSC again asked that aspect. See your question, which one of the following is not likely the measure government or RBI takes to stop slide of Indian rupee? Okay, exchange rate risk. And here various options are given, and see, we have discussed this question in the lecture series of monetary policy. But let's see, is encouraging borrowers to issue rupee denominated masala bond. So how will this reduce the exchange volatility risk? Let's see it. Okay, before masala bond, let's see a normal bond. Okay, which is not a rupee denominated bond but a dollar denominated bond. Suppose there is a entrepreneur A. Okay, A has taken loan of $1,000 billion. Okay, for 2 years. When A had taken loan, that time exchange rate was $1 is equal to 60 rupees. But after 2 years, the exchange rate become $1 is equal to rupees 70. Okay, anything can happen. So how much A repaid? So A took 1000 into 60. So that is 6 lakh rupees. Okay, sorry, that is 60,000 billion rupees. Okay, but now since exchange rate has increased, A will repay 70,000 billion rupees additional. Okay, we are not taking interest into account here. Okay, assume that it is interest free, but still due to exchange rate risk, entrepreneur has to pay extra amount. Why? Because the loan is in dollar. Okay, reverse can also happen. Okay, if there is appreciation of Indian rupee, okay, in case of appreciation, entrepreneur will have to pay less money. But that is a rare case, because whenever appreciation happens, appreciation is not always good. It makes our export less competitive. So RBI acts and stops the appreciation. So you can understand this is the risk in borrowing in dollars or euro. Now in case of masala bonds, they will be issued in rupee. So what entrepreneur will do? He will borrow 60,000 rupees. Okay, here I said 1,000 billion rupee, so it is a highly unimaginable figure. So erase the billion. Okay, $1,000, 70,000. Okay, so 60,000 rupees suppose entrepreneur has borrowed. Now after 2 years, since the loan is in rupee, entrepreneur will pay same amount, rupees 60,000. Okay, we are not including interest, okay, for simplification. So in case of masala bond, there is no exchange rate risk. Okay, exchange rate volatility not there, because we are not concerned with the value of dollar. Okay, but here investor may face loss, but not the borrower. So that is the difference. And see here, which one of the following is not most likely measure RBI takes to stop slide of Indian rupee. If borrower borrowed more from dollar, so dollar's demand will increase, so it will lead to slide of Indian rupee. So during depreciation rupee, issuing masala bonds is always beneficial, so it will not increase the sliding of rupee. Okay, it will not lead to more depreciation of rupee. So I hope you have understood it. Okay, so like we have masala bonds, there are some more types of bonds, so let's discuss it quickly. Okay, these are important from your 2024 prelims perspective. Okay, so see, Yankee bonds are issued in dollar. Okay, then we have samurai bonds, yen in Japan, then bulldog bonds in British pound sterling, Matilda bonds in Australian dollar, panda bonds Chinese renminbi. Okay, and one more important bond is there, that is known as catastrophe bonds or CAT bonds. These are disaster risk protection bonds. Recently World Bank issued CAT bonds for Jamaica. Okay, so this is regarding various special bonds, like we have masala and Maharaja bonds. Okay, don't confuse with masala and etc. Masala name was given to show the cuisine culture of India. So this is the elaborate discussion of masala bond. Now see this, in the context of finance, the term beta refers to. So answer is, it is a numeric value that measures fluctuations in stock changes in overall stock market. Similar we have alpha also. Okay, alpha also measures the same fluctuation etc. Okay, search for it, what does alpha shows. So what you can see here, key terms from finance are important. Not in detail knowledge about the key terms, but basic knowledge. Same way, there is another important term which was in news, okay, in the media. So we will understand it. That is nothing but short selling. Okay, so before understanding the concept of short selling, let's understand what is meant by long position and short position. So long position means investor has bought shares and owns them in expectation that its price would rise. So remember, in long position, investor purchase the share in expectation that price of them would rise. Now there is another position, that is short position. And to understand short selling, you must know short position. So in short position, investor has borrowed. Now see the difference. See the here difference. Investor has borrowed, and in case of long position, investor has bought the shares in expectation that its price would decline. This is the difference. What is the difference in long position? What is the expectation? Price would rise. And in short position, there would be decline. And long position, bonds are purchased, and in short position, bonds are borrowed. Now let's understand the concept of short selling quickly. So what is short selling? In short selling, investor has short position. Okay, so let's, all of you know, it was in news regarding Adani case. Okay, Hindenburg had short sold Adani securities. Various Adani securities. So let's see short selling. Now what happens? Suppose there is a seller. Okay, let's say Ramesh. Okay, Ramesh purchases, not purchases. In case of short position, what we have? Borrowing. So Ramesh borrows 10 TCS shares. Okay, for rupees 100. Now what Ramesh does is he sells the share. He do not have ownership of that shares, but he sells the share. Okay, for rupees 100. Because he thinks that price of shares would fall. And what happens? Actually price of shares falls. Price falls to rupees 90. At that time Ramesh purchases at rupees 90. Okay, he purchases at rupees 90, and by the end of day he returns back share to investor. So what is the profit of Ramesh? Rupees 10. Okay, assuming that he need not to give any commission, or even if there is some commission or some interest that should be given to investor, so even if that we deduct, then also Ramesh will have profit. Okay, because obviously he will not give entire 10 rupees or more than 10 rupees. There would be some agreement. So this is the mechanism of short selling. But remember, here is anticipation that prices of share will decrease. So what if prices of shares do not decrease? So consider same case, Ramesh, okay, with 10 TCS shares worth rupees 100. He sells it, but instead of a decrease in price, shares price increases to rupees 110. Okay, so Ramesh has to purchase it at rupees 110, and then by the end of the day he has to return the shares. So here there is loss of rupees 10 for Ramesh. So this is the mechanism of short selling. I hope you have understood it. Okay, so I have explained it elaborately, but just remember short selling, short position and long position. UPSC may simply ask the term short selling, which was often mentioned in news, is related to. Okay, now another question. A great deal of foreign direct investment into India comes from Mauritius, then from many major and mature economies like UK and France. Why? Okay, so in our external sector topic, we have discussed what is meant by indirect transfer. Okay, so please, along with this discussion, watch that video also. So answer is India has double taxation avoidance agreement with Mauritius. So what majority of companies do? They establish shell company in Mauritius, which is tax haven, and then they route their investment through that shell companies to India. And since India has signed DTA, double taxation avoidance agreement, with Mauritius, so they need not to pay another tax in India. So in this way there is more FDI from Mauritius. So answer is B. Okay, now see the news here. a shift in focus towards preventing tax evasion. Okay, so you can understand this leads to tax evasion, and there are various methodologies like treaty shopping, okay, round tripping, which we have discussed in topic of external sector. So please go through it. Okay, so a shift in focus towards preventing tax evasion or promoting bilateral investment flows. The amendment of DTAA by India and Mauritius signals paradigm shift from promoting bilateral investment flows to preventing tax evasion. So there has been amendments in DTA, so remember it. Okay, now question regarding forward market commission. So remember, the forward market commission, it is a regulatory body for commodity market in future market, and now it is a division of SEBI. So answer is B. Okay, and limited liability partnership. Which of the following is not a feature of limited liability partnership? So answer is A, that is partner should be less than 20. Remaining are features of LLP. Okay, so LLP, here internal structure of company is regulated to statute in case of company, but in case of LLP is to contractual agreement, and LLP has more flexibility. So you can focus on these crucial points, just understand it, because the remaining are features. Okay, so in India, taxes on transactions in stock exchanges and future markets are levied by union, collected by states. So this is incorrect. Okay, levied, both levied and collected by union. Now imagine, where are stock exchanges? Okay, major two stock exchanges, that is BSE and NSE, are in Mumbai. So majority of transaction will happen in Mumbai. So only Maharashtra will benefit from it. So this won't be a case. Okay, so answer is D, that is neither 1 nor 2. Okay, last question. Which of among the following pair is not correctly matched? Japan, Nikkei, correct. Singapore, Shom, incorrect. It is not Singapore, but it is Shanghai Stock Exchange. Okay, remaining pairs are correct. So this was our discussion regarding topic of finance and investment. Okay, we have comprehensively discussed all PYQs along with incorrect options and some important themes for your 2024 prelim. So I hope you have enjoyed the session and do like the video, and if you have any suggestion, please comment. Okay, so all the best for your examination.